This is nearly the final and last topic for the semester. So how can we deal with partner risk in terms of derivatives? Because I was always saying that okay, if we are buying an option or other derivative, the derivative is only providing insurance against the market related risk, so the volatility of the prices and changes of interest rates. But at the end of the day, what happens if our partner is going down? And that's why we have this chapter here, so chapter 20 in the book. And practically it says that if we have bilateral agreements, and nowadays since 2008 this is only available and allowed between or in case of non-standard derivatives. So if there are standardized derivatives, it must be traded through central clearing parties and not dealt with as bilateral agreements. But if we have some kind of collateral, practically we can eliminate the credit risk. Or maybe not, but how can we deal with this one? So practically this over-the-counter derivative transactions will be assessed in this session. So what happens if they are bilateral, and how can we calibrate the related risks? So first of all, this is happening between non-systematically important end users and other counterparties. So we cannot say that what happens if we are doing or conducting trade with the equivalent of Lehman Brothers or long-term capital management, so someone who has a significant influence on the market because they are supporting it. In this case, they have to run through the central clearing parties, but here we have this degree of freedom. So first of all, we have two options. One is the credit value adjustment. It means that we can suffer losses as a derivatives leader because the counterparty goes down. So we sold someone an option, and then they are going down, or what happens with in the case of the other case, when we are buying an option and then the dealer is going down. So practically these are symmetric cases. So that's why we have to deal with only the CVA, so the credit value adjustment scenario. And what happens in case of credit exposure on derivatives? So okay, we have these bilateral transactions, no collateral is posted. Later on it will be prescribed, but right now it's not posted. And we have just two players, dealer and the counterparty. And let's assess only the dealer's exposure to the counterparty. So practically the derivative can be a liability, an asset, or none of them for the dealer. If this is a liability, then we can say that we have a short position in an option, so we are writing out an option, collecting the fees, and sooner or later we have to serve the client. Or if this is an asset to the dealer, it means that we purchase the option, so we pay the option fee, and sooner or later we will be served if we are requesting the execution of the option. Or if it's not none of the above in case, then it can be a forward contract, it can be an interest rate swap, but practically the book deals with only the first two cases because it's much more simple. So okay, in the case of its liability, so what happens? We are writing out an option, partner is going down, then they don't need to be served later on. So for us it's no problem that okay, we have the money, so we sold the option, and after that we don't have any further exposure in terms of credit towards the counterparty, Once they are liquidated, so their positions are written down, then we have to pay the negative value of the derivatives, but that's all. So it's cool. If we are secured by an option and in this case our partner is going down, then practically we have a huge exposure, because mostly the entire risk management depends on their viability. So that's why we have to say that we need some kind of security. So right now we don't have this. And it's so nice, the book says that you may or may not have credit exposure in other cases, which is quite dull. Okay, so what happens in the case of the credit value adjustment scenario? So first of all, if we are saying that, okay, the dealer calculates it for each counterparty, so what happens if they are defaulting, and also what happens in each derivatives, then practically we have to estimate the expected loss due to the default of the counterparty, and that's why all the mathematics behind this will be familiar from the last week when we were thinking about credit default swaps. So the situation is similar because we have some kind of recovery ratio, we have some estimated probability of default. Just in this case we have these special issues that if we have a derivative in our balance sheet, then we have to correct the value of the derivative with this CVA value. And also there is a chance that profit will be increased or decreased because of the CVA. So if the CVA is increasing, then it decreases the profit, or if it's decreasing, then it increases the profit. So not just balance sheet effect, but also profit effect is added. And what kind of ingredients do we need here? So first of all, the longevity of the derivative, the number of intervals when it appears, and then how can we estimate the value or price the value, the risk neutral probability of a loss, and later on. So this will be similar what we had in the case of the CDS. This one, the present value of expected net exposure, in the case of the counterparty goes down at the midpoint, so between two intervals in the middle. Practically the book doesn't provide any numerical example, so they are saying that we should run some kind of Monte Carlo simulations. So let's see that what are the possibilities. So let's run 10,000 simulations that what is the possible present value, and after that we can pick at the extremities, and we can have the recovery rate for the funds, because maybe we can get some cash back, because obviously if someone is writing out an option, usually they are hedging it with some long positions in some assets, so this replication should happen. So that's why we can expect some kind of recovery rate also at the end of the day. Okay, so the present value of expected loss from default during the ith interval will look like this one. So okay, we have the probability, we have the value, and we have the recovery rate. Adding them together will provide us the total expected loss. So after that, the funny thing is that we should simulate this one, and we should model the Q. Otherwise, the debit value adjustment will mirror completely the CVA, just it's going backwards, so it's negative when it's supposed to be positive, so it doesn't provide us any kind of adventures. Okay, so how can we model this? Practically we can build up the following steps. So first of all, counterparty credit spreads can be used, so that's why credit spread can be an efficient tool here, because we can have we can assume the hazard rate from this one, so taking the credit spread divided with the recovery rate, and after that we have the hazard rate, then the probability of number of default, sorry, number, so probability of no default will be practically the the present value, so it behaves like a present value calculation. Just right now we have the hazard rate as instead of an interest rate here, but the mathematical background is the same and the logic is the same. And after that, if we are adding them together, so let's see that from each time to time, so between t minus 1 and t 0, or I minus and I, we can see that yes, the probability of failure will be that, yeah, what happens in time, so for each time steps. So if we are eliminating the hazard rate and we just giving back the credit spreads, we can see that credit spreads multiplied by the time divided by 1 minus the recovery rate, so possibly the loss ratio, then it's on the EXP, so on the Euler number, will give us the data. So practically between discrete time data points we can estimate the risk neutral probability of loss, because right now we are assuming that there is no correlation between or no relationship between the level of exposure and the probability of default, which is usually not the case. And the book later will suggest that there can be some relationship, but it doesn't care about it, so they don't provide us any kind of equation that how can we add this. They are saying that, oh, we should compensate, otherwise it's not dealt with. And also this Monte Carlo simulation part is absolutely not defined at all. So I was hoping for better description from the book, but yeah. Okay, so still the entire thing depends on the time intervals. Then we have to think about what happens between the two time intervals. So practically when the two counterparties are defining their agreement, so this is the ISDA master agreement, so the contract, then it contains this credit support annex, which defines the collateral posted by each side, so this is the C, specifies the haircuts to remove or at least to limit market risk, so the volatility of the value of the collateral. And after that, so inside this credit support annex we can find the collateral agreement, so the level of exposure will be something like this. So the market value of the outstanding transactions minus the collateral and practically the maximum. It can be 0 or it can be this number when we are increasing above or under, falling under the collateral. Or if they are the same, then it will be 0. So the problem is that still data generation and position evaluation takes time. So usually there is this curing period, which means that some time elapses between the definition of the value of the collateral and the value of the position. So what we can see as the value of the collateral will be from the past 10 or 20 days, and of course it can fluctuate at the same time, so that's why they are trying to define the midpoint, so the complete absolute average between the two data points. And also they are trying to simulate the value of the position for this time period, and after that we can see that the collateral at time of the default will not cover the portfolio. So there will be always some kind of disparity because this whole assessment is not happening in real time. But on one hand, for me, it's quite scary that they can live without collateral for 20 days. Even nowadays. So nowadays it's supposed to be easier. Okay, but maybe the reason behind this is not just availability of data or the speed of the market, but also the bank should adjust their position, so it would generate so much transactions, and that's why transactional fees that they have to limit it somehow. Just in this case, they will be less responsive to changes in the underlying position and asset value. Or if with the right calibration of the haircuts, maybe they can smooth this thing out by determining the collateral with higher conservative behavior. Okay, other concept is the peak exposure. So what happens when things are going sideways? So if we are generating a lot of simulated cases, then let's see that what happens in the high percentiles. The situation is highly similar what we did during the last semester at International Financial Management, when I was simulating foreign exchange rates with the Garch model, and practically I was looking for the 95% percentiles or probabilities, and because I was running Monte Carlo simulations with the Garch model, because just I was using 100 instead of 10,000, and after that we can say that okay, let's look for the 250's highest exposure, because if we are doing the math, then this will be the peak exposure. But these numbers were also absolutely arbitrary, so made up by the book. It depends on the company, but I would be much more happier if they would give something from the regulation. Other thing can be downgrade triggers. So in the ISDA master agreement and in the credit support annex, they should define that what happens under the scenario of downgrading is happening. So if they are, or one of the counterparties or the dealer is falling under a certain level of credit rating, then the other has the right to increase the collateral to terminate the transactions. But it was also not defined that, okay, but how much more can be the collateral? So how can we calibrate the additional collateral requirements? Okay, terminate transaction is quite obvious, so we can say that now it's 0. But this part was also absolutely not defined. Impact for the new of a new transaction. So in this case, practically we are adding a new position here, and what happens? It will have a similar behavior like the delta Greek letter in the case of the option. So what happens? But okay, there it was that what happens if price increases in the underlying asset. Right now we can see that what happens if the position increases. And the book after that, it states that okay, new transaction can be positively correlated with other transactions. So we can add things together, so that's why the risk or the exposure accumulates upwards, or if it can happen that okay, we are adding new position, but practically it reduces the exposure. But after that, at the mathematical level, so at the level of equations, it was absolutely not considered. So yeah. Okay, but how can we calculate this? So how can we say that we have a fixed position, but the spread starts to change. So this will be exactly like the Greek letter of delta, because now it changes. Okay, not the market price, but the spread, which is related to the risk-free asset. So at the level of interest rates, it's like delta. So we can say that this is behaving like that. And to estimate this, it would be absolutely ugly. So that's why this adjoint differentiation was created, because if we are just adding together the changing nature of the probability of default with the CVA, then we got this thing. And also, if you remember the Taylor equation, or which is not the Taylor rule from monetary policy, that was the Taylor equation, how they were able to build up that practically they start not just so this first part of the estimation is a linear one. So what happens if we are adding just a linear line? The second thing will be, okay, but what happens if we are making it more curvy? Because squares of the deltas is always looks like as a curve. So it could be on the third level and it would be much more curvy. So practically we are trying to fit to the change of the data, and they are stopping here at least. So still the logic is absolutely the same. So at the in all the cases we have to compensate with the changing time intervals. So this is ti minus 1, then they will be on the squares at the second time. Yeah, I was using this negative and positive numbers because the book exchanged the two sides in the equation, and it was so stupid that I had to change, or I wanted to maintain the ordering this way. And otherwise we can see that, yeah, spread was changing. Then still the VI, which is absolutely not defined in this chapter, it will be standing as the same, just we are focusing only on the delta of the spread. And also this equation is required by Basel II. So this one is practically the industry standard, what you can see here. My other favorite section in the chapter was the wrong way risk. The probability of default is not independent of the exposure. So if we have the partner risk and also at the same time the exposure, they can be interlinked. But after the definition, there were no mathematical expression that how can we describe this or how can we add this to the CVA. They are not independent. So thank you. Okay, and after that there were some approaches described by the book, that how can we model single transactions with positive values. And we can assume really simple facts. So first of all, there is a one derivative, and the next thing is that it is a positive value to the dealer, so practically we are buying things, and they have to sell later on, and the dealer has booked an option from the counterparty. So this is practically an example for that one, because we are in positive until they are not going down, so that's why they don't have to go down. And no collateral was requested, and the payoffs of the derivative transaction occurs only at the expiration date. So this is a European option. This is absolutely simple. The exposure of the dealer to the counterparty will determine the value of the transaction at a time. And in this case we can define that, okay, now, so previously the CVA was inside the summing function because it was changing from time to time. But right now we can say that no, the derivative value is today, so that's why we can move it out. It's not summing up anymore. And also, since the whole position is happening only, or it will be executed once in the future, so that's why it has only, let's say, a single recovery rate as well. So we were able to eliminate this one. Just we can see that the different probabilities of default are should be summed up in the future, but that's why these simplifications were necessary, because in this case we have this. And so how can we determine that how the value of the derivative today will be related to the value after defaults? So how can we compare them? Because at the end of the day, this is what is relevant for us, because if we would like to determine any kind of collateral requirement for the future, practically these value differentials will be necessary to do this. So value after default will be described by this without default minus the CVA relationship. So practically we have to do this one after we are adding all the numbers together, putting things down, and after that we have this expression. Yeah. So the effect of default is to reduce the value of the derivative. Yeah, obviously. So this must be compensated with this one. So this will be smaller than 1, obviously, by a proportional amount equal to the cumulative risk-neutral probability of default. So U. Because practically this is the non-recovery thing, these are the probabilities related to them, so at the end of the day this will be smaller than 1, so yeah, it will be compensated. Okay, but how can we do this? So we have this value here, then the book says, okay, let's take an unsecured zero coupon bond issued by the counterparty who can go to default. So there will be also two bond values, the value of the bond without default, so this is the B0, and the actual value of the bond, which obviously considered to be risky because they can go down. So this is completely theoretical, this is the market value. But in this case, because if we are looking on the two things, we can see that yeah, they are building up at the same way. So that's why I mentioned that it will be familiar from the last week's class related to the CDS. And they have the same recovery rate because it's issued by the same company. So why not to use both the values? So if we would like to define that how the F, so the value with the probability of default is related to the no default scenario, practically we will get the same ratio just between the two bond values, and that's why we have we can now instead of playing with this part of the equation, which would be completely ugly, so we can circumnavigate this, because now we just have to think about the values of these bonds. And the values of these bonds will behave nicely, because we can say that, oh, without any partner risk, it will be valued in like a zero coupon bond. And with the partner risk, it will be valued in like a bond, so practically the yield difference will determine what is the difference between them. And in this case, this is leading us back completely to the CDS logic, which says that okay, the difference between a risk-free bond and a risky bond will be the credit spread, or at least their yields will be different like this one. So if we are highlighting this, at the end of the day we can say that yeah, the discount ratio will depend on the yield differential, so the credit premium will determine everything, so the value here as well, or at least the present value of this spread. So yeah, so credit spreads are sooner or later everywhere, so even in the definition of this position. And after that there are not so many examples, so the book provides us two possible calculations. So one is when we can see that why the book maybe doesn't want to deal with the Monte Carlo simulations, because they are saying that okay, there are different values for the there are different possible values for the collateral, and what happens if they are changing back and forth, and practically they are writing up 4 different scenarios. So in two cases the values are positive, in the other 2 cases the values are negative, and in 2 cases the transaction value is bigger than it will be later on, due to this lead lag situation between the determination of the collateral and the transactions, which means that we have some excessive exposure of 5. If it's smaller, then practically we don't have exposure, so we cannot consider as negative 5. It will be just 0. We will be happy that still we have some buffers. If it's a negative number, then still we can consider that if it's more negative than the collateral's negative value, then it's 0. If it's a bigger negative than the collateral, then it will be excessive collateral. So we should deal with this one. So practically this is ugly, but I think it's also quite obvious. Another example written by the book is this single transaction with positive value. So if we have a 2-year uncollateralized over-the-counter option sold by a company, and the value of the option is $3, and we're assuming that there is no possibility of default behind this, but there is a 2-year zero-coupon bond issued by the company, let's say, which had a yield that is 1.5% greater than the similar risk-free bond yield. Then we can estimate the value of the option, which is great because if we have the option value without any consideration of the probability of default, so we determine the option value just with the black source functions. So this 3 was coming up without considering or just focusing on the market risk, but also we can pair it with corporate bond and the risk-free bond yield premium. Then practically we can also calculate the value of the option. So this is not just a romantic adventure that, oh, what happens theoretically. Practically we can make the option valuation much more realistic by just adding that, okay, this is the credit spread, and And at the end of the day, it's so stupid. So we can say that, yeah, this is what we get with the black source, this is what we get with the yield premium. Okay, this is for 2 years, and yeah, this is the actual value of the option. So we can see that this is going down like any kind of present value. So it's quite funny, and that's why the book was saying that dealing with credit risk in terms of derivatives, it reduces the balance sheet. So yeah, because this is operating like a present value, so that's the reason. So practically that's all.